Hello and welcome to the 793rd meeting of the Economic Club of New York. I'm Barbara Van Allen, President and CEO of the club. It's a pleasure to be here with everyone today. Before we begin, I want to extend a warm welcome to students joining us virtually from Fordham University, Harvard University, and Mercy University, as well as members of the 2025 class of fellows, a select group of rising, diverse, next-gen business thought leaders who, frankly, we now have over 100. It's just wonderful. It's an annual program, and that's well underway. The Economic Club of New York is proud to stand as the nation's leading nonpartisan platform for discussions on economic, social, and political issues. For more than a century, the Economic Club has been honored to have thought leadership and dialogue across a whole range of timely issues. Today, we're honored to continue that tradition with our guest, Nathan Sheets. Nathan is the Global Chief Economist at Citi Research. In this role, he leads Citi's surveillance and forecasting of the global economy and directs the analysis of the firm's economics team. He interacts closely with Citi's major institutional clients and internal risk takers and publishes research on cross-cutting themes shaping the global economy and financial markets. Most recently, as chief economist, and he was also a member of the senior investment team of PGIM Fixed Income. He also served as Undersecretary of the U.S. Treasury for International Affairs, representing the U.S. in international economic issues. Previously, he held positions with Citigroup as Global Head of International Economics and with the Federal Reserve Board as Director of the Division of International Finance and FOMC Economist. That's a big job there. In addition, Nathan was a senior advisor to the U.S. Executive Director of the IMF and a visiting fellow at the Peterson Institute for International Economics. He joined Citi in October of 2021. He earned his undergraduate degree from Brigham Young University and his PhD in economics from MIT. Today's program will be a fireside chat. We're honored to have Jason Furman as our moderator. Jason's the Aetna Professor of the Practice of Economic Policy, jointly at Harvard Kennedy School and the Department of Economics at Harvard University. Questions can be added to the chat box, so please do not hesitate to put those in. Time permitting, Jason will try to bring them into the conversation. As a reminder, this discussion is on the record. We do have media on the line, and finally, we will end promptly at 12:45. Now, without further ado, I'm happy to pass this time over to Jason and Nathan. Thank you both.
Great. Well, I'm so excited to be here with Nathan. There's no one I would be more interested in getting their views to understand just the amazing set of things going on in the world. My plan for this discussion is to have three parts. The first part is actually not to discuss the elephant in the Oval Office, but to understand as much as we can about the global economy, the underlying trends that are not related to the minute-to-minute policy changes emanating from Washington. But then the second part of the conversation, want to dive into those minute-to-minute policy changes emanating from Washington and what they are or aren't doing to the economy. And then finally, want to talk about the longer run implications for the global economy of what's going on in the United States. So welcome, Nathan.
Pleasure to be here. Thanks.
So tell me everything you would have thought. Let's start with the United States, and then we'll do a round of other countries around the world. Just what do you think was going on in the United States when President Trump walked in the door? Were there, vulnerabilities cyclically? Where were we in terms of productivity over the medium and long run? What are the most important underlying baseline trends? Inflation, whether or not it had landed or not in the U.S. economy.
Candidly, as the year began, my feeling was that the U.S. economy was in a unusually strong position. First, we had seen a significant resilience of the economy in the previous few years in the face of this very aggressive central bank hiking cycle, the 525 basis points of hikes from Jay Powell. But in addition, there were some really important structural developments. The US economy had significantly outperformed the rest of the world, at least other DMs, over the last few years. We're seeing evidence of ongoing reshoring. The US was benefiting from having a cheap and stable energy supply. The US looked to be the center of the digital AI tech revolution, and that was attracting a lot of investment. And maybe one summary statistic for all of this is the US had seen its share of global foreign direct investment, or FDI, increase significantly. Now, of course, there were some question marks about the path of inflation, and the Fed had begun a cutting cycle, but how far they could go remained an open issue. But broadly speaking, I think it was a very favorable outlook. And you mentioned productivity specifically. At a minimum, productivity was back to kind of where you'd think it should be based on a 10-year kind of trend. And arguably, and these debates were being had, arguably maybe had pivoted up a little bit as well.
Just to push on the vulnerabilities, the argument that inflation hadn't landed, so the Fed doesn't have much room to cut rates at the sign of nervousness about the economy, that consumer spending was running through people's savings, increasing borrowing, and that the stock market was, in some sort of bubble. Those vulnerabilities.
So I'll take them in opposite order, the way you stated them. For the equity market, I very much agree that as we entered the year, I think stocks were priced, if not for perfection, they were priced for something that was approximating it. But I don't think I would use the word bubble or necessarily mispricing. But I think those values reflected, one, the ongoing meaningful growth of earnings of U.S. firms. It was some of the bullishness that I described on macro performance. And it also very much reflected a view that the U.S. would be, if not the only country to benefit from AI, at least a central beneficiary of AI. But I think in each of those cases, there was an open debate about whether they were too optimistic or not. On the consumer, upper income consumers clearly were in a strong position. Lower income consumers were showing more of a pinch. But broadly, as long as the labor market continued to function, it seemed like those lower income consumers would continue to be paid and continue to spend. So the labor market was the key, and it looked all right. And then finally, for inflation, that was obviously something we needed to watch closely. But I was reasonably comfortable that shelter inflation had been very elevated, was in the process of coming down, and not as comfortable, but at least hopeful that we'd also see non-shelter inflation come up. One final point, another vulnerability that you didn't mention that I want to emphasize was true going into the year and remains true, is on the fiscal side and the size of the budget deficits and the debt, and what that means for Treasury issuance in the years ahead.
What's the time scale on that vulnerability, do you think? I mean, we know, you go bankrupt slowly and then quickly.
So it depends. The answer to your question depends on what we're worried about. If we're worried about some kind of deep kind of pullback from investors in their willingness to buy U.S. Treasuries, I think it's probably the probability of that is not identically equal to zero, but I think for the foreseeable future it's low. But what I'm seeing as I talk to global investors is concern about who's gonna buy all the Treasury issuance. And just to parameterize it, if you add up all the expected deficits during the coming decade, you end up with a projected Treasury issuance of something on the order of $25 trillion, which suggests the Treasury market grows from, say, 27, 28 trillion up to 52, 53 trillion. And I do think that we are likely to be paying a little bit more in order to issue that debt than we would have if we had a more disciplined fiscal position. It's hard to parameterize it. I put it as maybe 30 basis points plus or minus a little bit. But I think that's right now where the rubber is really hitting the road, is I think it's a little more costly for the Treasury to issue. And candidly, that fiscal premium, I think we've seen it shows some volatility as well. So my sense is a little more expensive on average, and those Treasury issuance rates are likely to be more volatile than they would be otherwise.
Great. So now let's go overseas to Germany. A lot of the sentences you said about the United States, AI, tech, productivity, I don't think you'd say any of those sentences for Germany. Want to understand why you think there's been just this huge divergence and how much their fiscal shift will address it versus there's a set of structural issues that go beyond fiscal, and you expect those to be addressed in a meaningful way.
Well, entering the year, I think globally there was deep pessimism about Europe, but particularly about Germany, as you highlighted. And I think they reflected a confluence of challenging cyclical factors as well as some challenging structural factors. On the cyclical side, global manufacturing has been very soft for a sustained period of time, and Germany is a leading global manufacturer. Secondly, the ECB had hiked vigorously, and in the US, we had a debate as to why the Fed's hikes didn't create more of a drag on economic activity. For a manufacturing goods intensive economy like Germany, those rate hikes, which now the ECB is taking off, had created a fair amount of drag. And then a third point that's critical is there were ongoing headwinds from Russia, Ukraine, and particularly in the energy space for Germany. So a robust set of cyclical challenges that Germany was facing. But maybe even more deeply and profoundly, the structural side of this. And let me highlight two issues here. First, when we think about the economy, say, of the 2030s, digital, virtual, AI, that's not where the German economy is currently positioned. They are a manufacturing powerhouse, but it's more of an industrial kind of flavor than it is of a digital flavor. I've heard this described as Germany stuck in a mid-tech trap, and getting from where they are, which is optimally positioned to compete in the 2000s and 2010s, to where they need to be in the 2030s is likely to entail some significant structural reforms. Secondly, Germany had hitched its wagon to China and to Chinese demand for its exports. And one, the Chinese economy has gone through a period of being softer. But secondly, and I think critically, the composition of China's economy is shifting. And we see this very clearly in the auto sector, where 10 years ago, 15 years ago, China would be a big purchaser of European, particularly German automobiles. And now, especially with the advent of BYD, China's increasingly a competitor, and arguably a competitor that's better positioned, consistent with my previous point, for the 2030s. So that's unlikely to be the engine of German growth that had previously been the case.
So they're making a fiscal shift. How much of that will address this problem, because the problem was deficient demand? Or if you think they're not making a structural transition to a digital economy, does it sort of trap them in more of the manufacturing paradigm as they build more weapons and the like, rather than getting them to this new place? So I'm just curious what you think about the fiscal side and what other structural changes you see coming with the new government?
Well, when I was at Treasury, we spent a lot of time negotiating with the German finance ministry and advocating for a somewhat more vigorous fiscal policy. It looks like now, roughly a decade later, that may be the direction that Germany is moving in. And my feeling is, one, Germany is probably one of the few countries in the world that actually has fiscal space. Two, as you highlight, I think there has been a shortage of domestic demand. And so an increase in fiscal policy and fiscal stimulus in this environment, I think, can be helpful. But I also agree that the underlying kind of more persistent challenges really are more structural, and the fiscal might be helpful as an anesthetic as they're doing this deeper surgery and these deeper reforms to their economy. I think the risk, and this is something that we've seen in Japan to some extent, and certainly in the United States, is that fiscal policy and fiscal stimulus, instead of being the anesthetic for the surgery of reform, can become a narcotic and something that the economy gets addicted to.
So the last economy I wanted to talk about before we get back to the US short run is China. And in some sense, it's the same questions as Germany. What do you think of the recent macro, not so recent anymore, but change in direction of travel in terms of macro policy? How much do you think that is what's needed to jumpstart the economy versus there's a deeper set of structural issues, and are those or are those not being addressed?
Let me respond to your question by analogy. Many years ago, I was the Japan analyst at the Federal Reserve Board. And at that point, the Japanese economy was slowing appreciably, and was a bit of a question, a bit of a debate as to why it was as weak as it was. And after a lot of back and forth, I came to the conclusion that spending demand was weak today because households and firms were looking to the future and were really worried about where the underlying fundamentals of the economy were. For example, the aging demographics and what that might mean. And I think that entering the year, we saw a Chinese economy that was caught in some of the very same kinds of adverse dynamics. And specifically, I think the key limiting factor for China as they entered the year, and it continues to be a concern, is extremely depressed consumer sentiment. And the consumers are looking to the future. They see debt and leverage like Japan some years ago. They see aging demographics. They see this ongoing geopolitical tension with the United States that I think is taking a bite out of China's economic activity, and a whole range of other challenges, including declining property prices. And the households, a big part of their balance sheet is invested in properties, so that's creating drag. So the challenge for China was very weak consumer confidence, consumer sentiment, and willingness to spend. And in response to that, the government has these growth targets that they're bound and determined to achieve. And year after year after year, that means fiscal stimulus of some stripe or variety, and more indebtedness. And I think that's essentially the vicious cycle that the Chinese economy was in as the year began.
Well, let's come back to the United States and now bring in President Trump. We've seen a big increase in uncertainty, a big plunge in consumer confidence. If you put the type of trade policies that he's done into a macro model and look at all the trade linkages, it takes off maybe 0.5 point of GDP, something on the order of that. You can tell me what your estimate is. A lot of people, though, are starting to talk about recession, implicitly saying that they think this uncertainty, this confidence matters above and beyond the standard macro linkages in the model. So if you could tell me how you think about the sort of hard changes where like prices and rates of return have changed versus the soft changes in sentiment and outlook, and what to look for in terms of their relative impact. And sorry, one last thing to layer into all of this. If you could even try to tell us sort of what you're assuming about tariffs coming forward, as you're answering this.
Well, I think the framework that you've laid out in the question is exactly the right one. And I think the first key point is that over and above kind of the macro dynamics associated with tariffs, the uncertainties about what these tariffs are going to look like, and the configuration of Trump's policies more broadly is creating meaningful uncertainty in the economy. We at Citi hear this regularly from our clients. We hear it from CEOs. Jason, as you highlighted, it's in the consumer sentiment data, it's in the business sentiment data. Arguably, we're also seeing it in the equity market. And a way to kind of bring that back into in a clearly economic context is that, in my view, the animal spirits effects associated with Trump's presidency on January 20th were distinctly positive. And it was supporting confidence in markets and so forth. And I think we've swung to a place where, as a result of this uncertainty, they are now negative. Now, you kind of pinned me down and said, well, how much is this going to take off of US GDP growth this year? And I'm not sure that I have a good answer for you there. And if you really press me, I think I would argue that by the end of the year, these uncertainties, I would expect, if we're still talking about Trump-related policy uncertainty at the end of the year, I would be relatively surprised. I think as the year progresses, its tariff policies and what they look like will dissipate, and we're likely to move from this kind of policy uncertainty more in the discussion of, well, what are the effects of the underlying policies themselves? And there, I think the reality is that so far these tariffs have felt at least a notch more aggressive than what I would have expected. So entering the year, I would have said that the overall effective tariff rate that the US charges, which you can think of as what tariff is imposed on the average US import crossing the border, that I'd expected that maybe would go up by 5 to 7.5 percentage points this year. Given what I'm seeing, particularly a more muscular view vis-a-vis Mexico and Canada, a more muscular view than I was expecting. Well, I was expecting tariffs on Europe, but a more muscular view there. And then also at the same time, a commitment on sectoral tariffs. Not so much a surprise on steel and aluminum, but it's very possible that we see 25% tariffs on, if not all our auto imports, at least many of them. And that's a significant tariff. That's 3.5 to 4 percentage points on the effective rate, roughly, right there. So I put all of that together. Kind of my expectation now for this year might be something more like 10 to 15 percentage point increase on the effective tariff rate. But we'll know more, hopefully we'll know more on April 2nd. That's the big day where the administration says they're going to talk about reciprocal tariffs and they're going to talk about their sectoral tariff. I'm not sure I got all the aspects of your question.
Yeah.
But
yeah, why don't I try a little bit harder to pin you down on a magnitude? If
Yeah,
we did,
sure.
let's say 10 to 15% tariffs,
Yes.
what do you think the macro impact is? GDP growth, inflation, and do you expect it to continue to depress the 10-year, or is there at any point at which expected inflation rises and that starts to move interest rates in the other direction?
Yeah, let me give you some specific numbers. So kind of bottom line relative to my forecast as we enter the year, I'd be inclined to probably take off due to maybe a little bit of lingering uncertainty, but mainly the larger tariffs and their effects, probably a half a percentage point from US growth. So if one entered the year thinking growth was 2 or a little bit more, now I think it would be reasonable to write down a forecast of something a little less than 2%. So that's kind of
before you keep going, I just want to be clear. This is conditional on some additional tariffs of the that you were talking about before.
Correct. It's the delta. And a rough rule of thumb, and so I already had some tariff effects in my forecast as the year began. And I do think that there are likely to be some policies, for example, on deregulation that are going to be supportive. And I think over time that the animal spirits will become less of a constraint. But it does seem reasonable to expect a weaker U.S. growth outlook for this year. But let me also give a rough rule of thumb here that I carry the following multipliers so that if we have a 10% increase in the effective U.S. tariff rate, the evidence I've seen suggests
10 percentage point, by the way?
Yes.
Okay.
Yes, I should have said percentage points. Is about 3/4 of a percentage point increase on the price level, which I think is likely to manifest itself in a year where inflation is 3/4 of a percentage point higher than it would be otherwise, and roughly similar kinds of magnitudes for the drag on growth associated with the tax on real incomes and the reduced consumer spending and so forth. So that's a rough rule of thumb. So I had some of that in there, and I put in a little bit more now, and that's how I get the half a percentage point of lower growth for this year.
Do you want to tell us your rule of thumb on the 10 percentage point for the dollar and for the 10-year Treasury? And for the dollar, what are you building in as a reaction from other countries, which certainly matters in thinking about the dollar?
Yeah, so the impact on the dollar, this is something that's got a lot of attention. Secretary Besson in his confirmation hearing said 10% increase in tariffs would appreciate the dollar by 4%. That strikes me as a very large number. Kind of the number I've carried is around 1.5% for 10 percentage points on tariffs, 1 to 2. But as I say that,
10 percentage points with what retaliation?
The 10 percentage points would be just the partial effect of U.S. tariffs. To the extent that you have comparable, retaliation around the world, then that net effective really would be the net effective for a tariff rate. Well, that's a good question. The implications of this for the 10-year, my feeling is as we're actually moving through this in real time, that the growth effects of these tariffs and of this policy uncertainty and where we are dominating the price effects. I think we'll hear Jay Powell later this week emphasize the two-sidedness of the risks, but I think he's going to particularly underscore that if the economy softens, they're seeing the decline in sentiment. If the economy softens, they're prepared to act. And when consistent with that, it wouldn't surprise me if the dots showed, say, 3 cuts for 2025 rather than just 2 cuts.
And that is, if the price level went up 3/4 of a point, GDP went down 3/4 of a point, a Taylor rule would say you raise interest rates, don't lower them. A sort of temporary supply shock view of the world would say look through the supply shock and lower interest rates.
Yes.
Financial conditions themselves are moving in response to all of this. Net, you think this leads the Fed to cut more?
I think what we're seeing and kind of the uncertainties and risks around these policies, and when you think about kind of a risk management approach to monetary policy, I see much more risk on the downside than the upside. But to be clear, I think to a first order, I don't think the Fed is like going to jump out of the gates with additional rate cuts here by any stretch of the imagination. I think the Fed, to a first order, is going to be looking through it and seeing where we land. But I gave you kind of my bottom line assessment that on balance, I think there's more probability they're going to be cutting than hiking in response to these shocks.
I mean, how preemptive can they be about those cuts? I mean, if you're looking at what might end up being a 12-month core PCE inflation rate of above 3% at the end of this year, if you get this set of tariffs, and they've cut rates and you end the year and, they've let inflation expectations rise, how you think they can afford to do that?
I think their choke point, I think you just put your finger on their choke point. If inflation is kind of moving sideways, 2.6, 2.7, 2.8, I think that there's scope for them to move. If it starts migrating up and you start getting three handles, I think it is going to be tougher for them. But again, kind of my expectation would be that there will be enough, if we're in this scenario where they're actually responding more aggressively than what we thought as the year began, that there will be some obvious downdrafts to economic activity that the Fed will be able to point to as clear disinflationary effects. And indeed, even by the end of the year, I'd expect that if we're in that scenario, that those disinflationary impulses are pretty clear, and we won't land with the three-handle inflation.
In this contingency where the economy takes a rapid turn down, the Fed does have a lot of space. So my worry is that they won't preemptively cut based on uncertainty. They really need to see the unemployment rate rise, and how much they need to see it rise depends on whether that underlying inflation is, as you were saying, 2.7 or has a three handle on it. But if things get really bad, one of the questions we got is whether the United States will have fiscal space to adequately combat a downturn. And does that cause a debt crisis? And by the way, do you think this is an administration and a Congress that would want to use fiscal policy as one of their tools?
Yeah, great question. And certainly the first line of defense, if we start to see things slow appreciably, is monetary policy. And as you said, Jason, that 425 basis points of dry powder that Jay Powell and his colleagues still have. But the scope for fiscal stimulus here is a very interesting question. If you press me here, my feeling is if we're in a place where there is appreciable concern about where the economy is headed and how things are going, that it's going to be hard to prevent the Congress and the president from wanting to provide some fiscal support. So I think that to the extent that we hear any narratives from the administration about fiscal discipline, that's one we can debate, will it really be fiscal discipline or just additional funding for tax cuts? But if we are in that world, I'm not at all comfortable that would withstand a downturn in economic activity. So my baseline there would be that Congress would want to help out, and that the U.S. will move. I don't expect, as I said, I don't think that leads to a debt crisis, quote unquote. But those risks 10 years ago, 20 years ago, I would have said were zero, and now it's non-zero. I think it's non-zero and small, but it's non-zero. And if we increase further the amount of issuance of treasuries, I cited the $25 trillion of treasury issuance in the coming decade. If that's an even larger number, then I think we may need to pay even more to issue it. So there are some risks there.
Yeah. I mean, my perception is also, if you're borrowing for a reason the market thinks is rational and reasonable, you have a lot more space to do it. If you're doing what Liz Truss did 2 years ago, or whenever it was, you have less space because they're worried about why you're doing it.
And I agree with that in the moment, but I think we're also at a place where even and think about during the pandemic, where the markets made plenty of space for the U.S. government to borrow. But in the aftermath, we're looking at these debt levels and their implications, and it's making people nervous. So I agree with that, but there still can be a hangover to negotiate through.
Yep. So let's stay on fiscal and not talk about the recession contingency aspect, which we just were, and just the modal outlook for fiscal. So the first question is, do you expect deficit path to be better or worse than a current policy baseline? Current policy being if you just did a straight extension of all the tax cuts, which have been in the law since 2017, and you had whatever deficit you get from that. Do you think the policy changes we're going to see are going to make something worse than that or something better than that?
You just described my expectation is that essentially what happens is that the Trump administration, the Congress, extend the Trump tax cuts, which is essentially the current policy baseline. And then from there, could we see some additional tax cuts? Trump has signaled, maybe no taxes on tips. There's been a discussion about SALT. There's been a discussion of some reduced taxes for particularly manufacturing that's done in the United States, and some other proposals that are out there. So there are some additional tax cuts that have been on the table. But at the same time, there are some DOGE savings that are likely to reduce expenditures, and they may be significant. And these tariffs, an implication of them is there will be some revenues associated with that. So essentially what I have done is just say, we're going to extend the Trump tax cuts. And that means we have this current policy baseline, and that there will be some additional tax cuts. But to the extent that that happens, they're offset by DOGE and tariff revenues. You press me as to which of those are more significant. Maybe I would say, given the rhetoric we're hearing from the administration, maybe on balance, there's a little bit of risk that it could run a little less than the current policy baseline. But I also know that, on down the road, there are all sorts of other risks, like where rates are going, and if the U.S. has a recession, which in a 10-year horizon is reasonable, could push it up. But maybe a little bit for pure policy, maybe the small risk that they're a little more disciplined than what I described.
And do you see DOGE as having mattered so far?
I think, and this I don't think is what you're driving at, but let me say I think it has mattered in contributing to this view of policy uncertainty and creating question marks in the minds of businesses and investors about where U.S. economic policy is headed. In terms of fiscal implications, it's really, really hard to get a complete accounting and accurate accounting of the effects of DOGE. But I entered the year thinking maybe DOGE could be $50 billion a year of savings. And now you could push me to 75 or 100 billion a year of savings, which accumulates to appreciable number.
But that's gross savings that might be offset by additional tax cuts above and beyond.
Oh, absolutely, absolutely. But get how far we are at the moment toward 50 or 75 or 100, I'm not sure.
And I hear a lot of business people taking DOGE quite seriously and expecting there to be deficit reduction coming out of this administration. Do you think sophisticated market participants are thinking that and pricing in that we're actually doing deficit reduction relative to current policy? Or do you think your scenario is give or take what's priced into markets already?
My sense is that what I describe is broadly consistent with market pricing. And if the deficit is larger than that, I think that there will be discussions with investors that we'll all be having in coming months and years to think through the implications. And if there were signs of additional discipline, that would be something that the bond market at least would consider good news.
Okay. So just super quickly on this, because I want to talk about the long run, just impact of tariffs, US tariff policy on other countries around the world. Just highlight a few. Is it a bigger impact than the United States is going to feel, a smaller impact? Are there any winners from the shifting that will result from this? Is it all losers?
I have a hard time thinking through and identifying any countries that are likely to win. I think our major trading partners, in one way or another, are likely to feel a pinch from higher tariffs. Now, the nature of the shock in the rest of the world in response to our U.S. tariffs is very different. As we said, that for the United States, as we impose tariffs, it's like a supply shock, drives up prices and reduces spending and real GDP. For the rest of the world, it's more like a demand shock, where they're less able to export. And for them, it has a clear kind of implication for their central banks, where the demand shock means less GDP, and it also means less price pressures. And for those central banks abroad, it's a clear implication that what they need to do is cut. And candidly, if I were an advisor to a foreign country that was experiencing these tariffs, that would be my policy advice. The central bank should cut, and that may be a more effective response than retaliating through tariffs. Candidly, I think that may be one reason why foreign countries have not been keen to retaliate aggressively on the Trump administration. So in any event, I think Europe is likely to get hit hard as a result of this. China, I think it's more already in the baseline. And if anything, maybe it's been a little bit more open to the idea of negotiating. If we go ahead with large tariffs on Mexico and Canada, I think they're going to feel it's going to be a very significant adverse effect. So when I look around the world, the tariff policies strike me as creating a lot of uncertainties, a lot of challenges for these economies, questions about growth, but at least a clear policy prescription of cutting central bank rates to the extent that it's feasible.
Great. So this is, we have 3 more minutes. And if you want to spend all of them talking about how the world is going to look different in the year 2030, say to 2035, as a result of these international changes. Is there new trading blocks that emerge, a resurgence of manufacturing in America? Canada joins the European Union. What does the world look like?
I wish I had a good answer for you. To a first order, I don't know. And so I think what it looks like in 2030, I'm going to give you essentially the same answer that I would have said before January 20th. And I think that the U.S. economy and its fundamentals are likely to continue to be in play. I would expect that over that horizon, we're going to see some significant structural reforms in Germany. We don't want to underestimate the capacity of the German public to come together. They've reformed before when they were the sixth economy in Europe, so I'd expect Germany to be in a much better place. And candidly, I think that the recent narrative on China has improved a notch. And why is that? Is we've been reminded about the technological prowess of Chinese workers and Chinese firms. First, we've seen it over the years with BYD, and now we're seeing it in the AI space. So I'd expect in 2030 that the Chinese economy is likely to be growing below 5%, but still growing more rapidly than many other countries around the world. But there's likely to be some fragmentation in the tech sector. But more broadly here, I'm skeptical that somehow over these Trump years that we're going to see the underlying structure of the economy shift dramatically. But let's talk in a few years, Jason.
Great. Well, we've covered an enormous range. I certainly feel much wiser about everything in the global economy, and I'm sure everyone who joined us does as well.
Absolutely. Terrific conversation, and thank you both for joining us. I think I noticed we had a very large audience today, by the way. Almost 100 folks came in virtually. So kudos to you all for giving us your time and for everyone that benefited from that. I want to just turn quickly to upcoming events. We have Jonathan Gray this Thursday, the 20th, from Blackstone. And that'll be followed by a webinar with Bill Gates on the 27th as part of our author series. April is also shaping up to be a full month. Coming to the club will be Mohammed El-Arian, Larry Fink, Austin Goolsbee, Darren Ajamoglu, and Dan Loeb. So, and there's more ahead for June. And of course, at any point, we sometimes, as we did with Secretary Bessent on very short notice, get cabinet officers. So please stay tuned and to our calendar. And before we close, I always like to recognize those attending that are from the nearly 400 Centennial Society members joining us, as their contributions continue to provide vital support to the club's mission. So thank you all for your unwavering commitment. And thank you everyone for joining us today. Have a great afternoon, and we look forward to seeing you next time. And again, Nathan, Jason, great conversation. Thank you. We all learned a lot. You're right, Jason. Thank you.